Ever wonder what dealer hedging really means and why it moves markets? Let's break it down with one of the biggest examples, the JPM collar trade, and how Level Beast uses it to sharpen your levels. What is it? JP Morgan's Hedged Equity Fund, JHEQX, runs a quarterly collar. They sell calls a few percent above market and buy puts a few percent below. On rollover days, the old collar expires, a new one is opened, and a 0-day deep-in-the-money call smooths the transition. Because the trade is massive and tied to SPX, it has the power to pin the S&P 500 like a magnet. Let's look at how the June 2025 collar shaped the market and how you could have read it on the chart. More importantly, let's look at how Level Beast's quant team reads it. And as we get closer to expiration, how we use it to develop accurate levels and the trade plan so that we can get solid trades and at times, those 10x trades. The first thing we do is define the structure. When we looked at dealer flows at the time, we noticed that dealers were heavy long puts at 5,290. This was a support magnet. They were heavy short calls at 5,880. This was a resistance magnet. And they had short put interest at 4,460. This was used for deep protection. It was less relevant for intraday trading. Why does this matter to us? Because these strikes are billions in notional value, meaning market makers had to hedge aggressively around them. Next, we consider dealer hedging logic. Our analytics showed near 5,290 dealers continued to short puts, meaning they sell futures as price drops and they buy futures as it rises. This creates a support/pin activity. We saw near 5,880 dealers were long calls. This meant they would sell futures as price rises, and this would cap the upside. So what's the overall effect? The market would oscillate in these areas with reduced volatility, which is indicative of positive gamma. But what we noticed was if the market pins at 5,880, it means that the pressure would have to release. And when those contracts expire, it's like someone removes the lid from the market and it can explode and move. Now we consider the expiration dynamic. So if you look at the chart leading up to June 30th, gamma decayed. This meant we would see weeks or maybe even a month of pinned pressure weakening. So essentially the force holding the market down would ultimately dissipate. Once the collar expired, hedging flows are released, implied volatility popped, and that's why we often see a shakeout and volatility expansion leading up to and after expiration. Let's see the breakdown on the chart. You've got your overall support level from the collar at 5,290. You've got your resistance at 5,880. You can see leading up to the expiration, 5 days before, the pressure dissipates. And we get a hard breakout. This is the magnet effect. And this is one of the key elements to understanding how the market will move not just daily, but intraday. There are areas in the market on a lower time frame that have similar behaviors, but there are more variables involved than just a simple collar from one hedge fund. Either way, we were prepared. Our thesis stated that we would see range-bound behavior 10 days prior, and then 5 days prior, if we kept testing 5,880, and we were holding above it, we knew into the end of the month we would get a pop. This ended up being a 10x trade for many. So in conclusion, when we watch the JPM collar strikes and we run our math coupled with our trading system, we don't predict the market. We anticipate where it's most likely to stall, pin, and release. Then we draw all that math up and we give it to you. Some of our traders only trade 4 times a year based on this logic, and it's huge. That's the edge Level Beast locks in daily. We turn Wall Street hedging mechanics into tradable levels, break them down, and deliver them to you every single day.